Hello and welcome to MF Corner. I'm Sonal Bhutra, and while we talk about pure equity funds, debt funds, it is a good time to talk about balanced advantage funds, the hybrid category, and target maturity funds, which is a debt kind category. Before we go to our guest today, let's quickly take a look at how balanced advantage funds fared this time around. Now remember, this category did see a lot of inflows in the last couple of months, but October did not work out so well for them. So 540 crore rupees in the month of October versus 1689 crores in September. So it has been gradually coming off after that surge that it saw in the month of July. And if we talk about hybrid category in general, that did see a lot of flows come by, especially in the month of July. Inflows were 28,880 crore rupees, and since then it has been a one-way down move, and now it stands at 14,156 crore rupees. A lot of changes that we saw on the market move, so investors did move to the hybrid category. So let's understand what the outlook is on balanced advantage funds, understand the nitty-gritties of this category, and also then focus on target maturity funds after we understand the first one. So let's focus on balanced advantage funds, investments that adjust automatically between stocks and debt. But how do they differ from regular hybrid funds? Are they the safer option in an investor's portfolio in a volatile market? We discuss all this and more with Amitabh Verma, director and co-founder of Fission Wealth. Amitabh, good afternoon. Thank you so much for joining in. You know, there was a point in time we used to discuss balanced advantage funds and target maturity funds on an everyday basis, but now looks like that excitement has come down. For someone who is just beginning, what exactly is balanced advantage fund and how is it different from a regular hybrid fund?
Balanced advantage funds and hybrid are hybrid funds, as you rightly pointed out. See, in the case of regular hybrid funds, they have a much more fixed allocation between equity and debt. Typically, if it's an equity-oriented hybrid fund, then it will be equity is closer to 65%. It could move a little bit here and there, but it's there. While in a conservative hybrid fund, it would be much lower. In the case of a balanced advantage fund, the leeway for movement of equity and debt is a lot more. Equity tends to move between 30 to 80%, depending on various market conditions and models which are used. So in a short way, balanced advantage funds are far more dynamic in terms of managing equity and debt. Often they are rule-based. And if you look at these in a broader sense, they offer much better risk-adjusted returns as compared to traditional hybrid funds.
Okay, so we'll come to the return metric in just a bit. You said the changes are rule-based. So they dynamically change equity and debt allocation. But what are some of the factors that a fund manager considers when they decide whether to increase or reduce equity exposure? If you can give us some examples here.
Right. So for fund managers to look at, clearly the market levels, market conditions come into play. So what would they look at? Valuations is a very important factor. There could be some metrics like price to equity, good price to book value. So these are a very important category or aspects to look at. The other factor is really sentiments, could be market, what is the kind of, whether it's bullish, bearish. So the sentiment and momentum also plays an important role. And third, there are several other factors. Bond yields could be there, the volatility or VIX indicator could be there, and a whole host of other things. So when you look at all these factors, then you try and build a model, a rule-based model. When an equity fund or when a balanced advantage fund manager look at all these models, so they build proprietary models. And on the basis of that, it would indicate what is the right level of equity. If it's an equity-oriented fund, then whatever is the equity mix, for example, it's 40%, I'm just putting it as a number, then the balance they would cover through an arbitrage fund and the rest would be debt. If if the fund has more leeway, it could move all the way from, as I said, 30 to 80%, depending on where or what is the model indicating. So in short, there are various factors which come into play in determining a model. These are back-tested. Fund managers spend a lot of time in testing, looking forward, how do these change? They adjust it sometime daily, weekly, monthly, depending on what is the mandate of the fund. And based on these, they come to a conclusion of what is the right level of equity in the fund.
Okay. So, you know, investors believe that BAFs will guarantee protection in market falls because it does have two asset classes in the portfolio. Is this the right expectation to set?
There's nothing guaranteed in that sense. The only thing guaranteed in a way is government bonds. But even government bonds come in with interest rate risk. So I don't think one should be looking at guaranteed as a form of for any category, including this category. But having said that, it's a question of probability. And the probability of a balanced advantage fund that it would preserve capital is far higher than many other categories. And that is where the strength of this category or strength comes in. Just if you look at it and if we increase horizon, and if you look at past data, as you increase horizon, the number of times a balanced advantage category would have given negative returns keep diminishing to a point of near zero. I'm not saying that past returns would be a reflection of the future, but clearly this demonstrates a certain strength of balanced advantage in being able to manage market falls. So I wouldn't take it as guaranteed, but I would definitely look at it as a much more conducive to managing both ups and downs of the market.
Okay, so there's nothing guaranteed because there's a significant equity portion as well. So in that case, Amitabh, how should a retail investor judge performances in different BAFs? What metrics should they track? And also, if they are little better than, the regular funds or specific asset funds, do you think they should definitely be a part of anyone's portfolio?
Yes, definitely. So essentially, what is BAF trying to do? A BAF is trying to capture some part of the upside and minimize some of the downsides. So if you look at it, so if a fund is, I'm just giving it as an example, if the fund is able to capture 75% of the upside, and when the markets go down, only experiences 50% of the drawdown, chances are that it would have given near nifty returns in a full cycle, as well as with much lower volatility. So that, to my mind, would be an excellent BAF fund. Closer to this, whatever the performance is, and depending on the mandate and time period, is what you would get in experience. If you are looking for a slightly shorter period, and when I say cycle, it's 5 to 7 years, then also it should give you better than fixed or debt returns, but with lower volatility than equity. So if you are getting 2 to 3% higher returns than a debt fund, but with much lower volatility in the shorter term, I think that's also a great way for a retail investor to look at it. So really, it's all about being able to manage or capture part of the upside and manage part of the drawdowns.
Got it. So like any other fund, which is say pure equity fund, pure debt fund, sometimes people just do lump sum in debt funds, right? Because it is capturing a duration as well. So are BAFs better suited for lump sum investment, or should one go about with SIP here?
In my mind, lump sum or SIP is far more a question of availability of funds with the client or investor, because really it's not a one or either. If you have funds today, you're looking at lump sum. If you don't have funds today, you're looking at SIPs. To me, a question would be far more whether it's lump sum or is it staggered through something like a systematic transfer plan? Because if you have funds today, then should you go it all in today or later? When I look at BAFs, the whole mandate of the fund manager is to manage different market cycles in a balanced way. So therefore, I don't think data suggests that having a significantly staggered approach would give you higher returns as compared to going all in as a category. If a fund is not dynamic enough to adjust, then anyway, you should not be investing in that fund. But that's a different point. So if a fund is dynamic, I would say that it doesn't really matter if you're doing lump sum or doing a small stagger. It's all about the investor's comfort. From a returns perspective, I don't think there will be any measurable difference.
Okay. And what about the holding period? Like any other investment criteria or investment goal, the holding period should be long enough to actually see the benefit of dynamic asset allocation?
Yes, absolutely. The holding period, if you look at the normal market cycles, they're 5 to 7 years. So for both equity and debt to play out, that's a good investment horizon. But a lot of people see it as 1 to 2 years as the desire, because of taxation benefits which accrue post that. It becomes long-term taxation. That's something which, while it helps from a taxation perspective, but if you really want to look at it 5 to 7 years, you would find that the entire notion of it being able to capture upside, manage downside will play out. This is a very important part of the asset allocation of an investor's portfolio. And therefore, I would feel that a lot of investors should hold it for much longer periods of time than they would hold some of the other categories.
Take that point, an important insight as well, that it should be held for longer than what other categories would be held on in your portfolio. It's very helpful, but we have to take a quick break. On the other side, we'll focus on target maturity funds. That's another category that investors should be aware of as well. Welcome back. You're still tuned into MF Corner. We spoke about balanced advantage funds. Now let's understand more about target maturity funds, passive debt mutual funds that have a specific maturity date, to understand what happens if you hold it till the target year, what it gives in terms of returns, and what is the volatility here, plus who should really consider investing in these funds. We will understand the impact of interest rates fall and rise and a lot more. We still have with us Amitabh Verma of Vision Health. Amitabh, while we talk about debt funds, it's slightly a more complicated category, right, versus a pure equity fund or multi-asset fund. So let's understand a subdivision of that. What are target maturity funds in simple terms, and how do they differ from, say, traditional debt funds or fixed deposits for that matter?
Right. Target maturity funds are passive debt funds, which typically, as the name suggests, have papers which mature till to a fixed date or a fixed time frame. Uh, they are open-ended. So in some forms, they are similar to debt funds because these are debt mutual funds. These are mutual funds as well. But the primary difference between a debt mutual fund and a target maturity fund are the underlying papers. In target maturity funds, you hold the underlying papers to maturity, while in a typical debt mutual fund, you could be rolling or buying new papers, as it's an open-ended fund where the maturity, the fund manager determines at what level of maturity they should be, and they buy and sell papers accordingly.
Okay, so there was a point in time we spoke about target maturity funds and balanced advantage funds a lot. They were very popular some time back. What is driving the interest specifically in target maturity funds? Are you seeing that interest continue? Because I know there have been a lot of changes in taxation as well.
Yes, I think that the interest in target maturity funds are reducing. Of course, they have been popular and they had a place in time. It's because, see, if you look at it, the taxation played a very important role. Post 31st March 23, the taxations have, there's no tax benefit on this. See, target maturity funds are very useful when you know that you have liability at a fixed point in time. And in that sense, they are better than fixed deposits because they have a lot more other benefits like liquidity and so on and so forth. But at the same time, a lot of people are looking at other categories like arbitrage or looking at equity savings or SIFs. So clearly what has happened in this period of time, target maturity funds have not had the same amount of traction as what they were having a 1 year or 2 year back. But clearly for the use cases, it's extremely useful.
Okay, it is extremely useful. So who should consider target maturity funds in that case? And at what stage of their financial plan? Is it when you start it? It should be a necessary addition to your portfolio. And when you have some corpus and you think you need it for a particular reason or goal?
Target maturity funds are for a particular reason. I don't think it depends on what stage of life you are. It is depending on your goal. If you have a goal, for example, of buying a house in 3 years' time, or children's education, which is due at a certain point in time, then you know that your liability is going to be fixed. And therefore, you could buy a target maturity fund, which matures around that period. If you're looking at other products like an equity, it could be volatile at the point of redemption. If you look at other products, it would have other challenges. But in this, you know that what you've contracted for, you're likely to get on the due dates or around the due dates. And therefore, people with fixed requirements often choose this kind of a fund.
Amitabh, recently the other phenomenon that has taken place is the rise in passive investing. Target maturity funds, they're kind of index funds itself, right? So is it important for an investor to have that sort of portfolio allocation? And how important would that be for an investor then?
See, again, as I mentioned, it is not necessary for every investor to have a target maturity fund. But for those investors who have fixed liabilities, it's a very useful addition. It's an index fund. The cost is very low. It is something which gives you liquidity. It is something which is more tax efficient than a fixed deposit. So there are many, many benefits to be able to manage those kind of liability or requirements where you want to have the funds to be safe as well. Usually, if you look at target maturity funds are in government bonds, GSECs, SDLs, or PSU bonds, which are much higher of higher safety as compared to, say, an NBFC FD, which may give a higher rate, which have a fixed maturity. So therefore, when you look at these kind of investments, you are looking at a combination of safety, liquidity, fixed timeline, better taxation, and therefore then it lower cost, and therefore this should be a part of your portfolio. But only if you have these kind of requirements which are more fixed in nature. It shouldn't just be there if you don't have a fixed nature. The only reason some people do tend to buy this is if they're looking at or trying to play the interest rate cycle. You take a much longer duration fund so that with a rise or fall of interest rates, you are trying to make money from that, but that's for a certain class of investors. For majority of them, it would be where it is matched to their requirement.
I take that point, and it is very clear that not every investor should have target maturity funds as a part of their portfolio. Only if you have a specific goal, and that is the reason why you want to use those funds, it should be there. So it's a good way to know that not every kind of asset category should be part of your portfolio. It has to be quite limited according to your goals, right? So, one thing which is very basic when it comes to debt funds, it is the interest rate movement. If they fall or rise, how will it affect returns for a TMF investor? If you can explain that in simple terms.
Right. So if the interest rate falls, there is mark-to-market gain on a TMF fund. Let me try and explain that, as you said, in simple terms, without using jargon. See, what happens if the interest rate of a fund is 7%, and if the interest rates have fallen by 0.5%, if the average duration of the fund is 5 years or longer, then typically you're looking at a 0.5 into 5, roughly 2.5% mark-to-market gain. So therefore, I have oversimplified it, and I'm just indicating it to show that there's a gain which happens, which accrues at the point in time when the interest rate falls. So a falling interest rate tends to give you a higher yield at the point. Similarly, a converse of that happens when the interest rates rise. If the interest rates rise, then the fund suffers a mark-to-market loss. Both these mark-to-market gains or mark-to-market loss means nothing if you're holding it to maturity, because in that case it plays out and you get the effective yield. So really the interplay is if you are looking at selling the fund at an intermediate period, or how it reflects in your portfolio during the journey.
Okay, so it is only if you take out the money or make changes to your portfolio before the targeted maturity date will the rise in interest rates or fall in interest rates impact the return that you'll get. Have we understood that correctly?
Yes, absolutely.
Okay, all right. Take that point. So that is how it differs from the debt funds as well, right? Because not everyone holds on a debt fund till maturity. And that is the reason why interest rates, when they go higher, you'll see lower yields, and vice versa as well. And that's how debt funds were in focus when there was an expectation of more interest rate cuts. And we'll, of course, also have to see what happens with RBI policy outcome tomorrow. There are so many things to talk about: the inflation number, the rupee fall, and their commentary as well. Of course, that will have an impact on debt funds as well. Thank you so much, Amitabh, for joining in today and patiently explaining these two categories. Very important to understand. They were in focus a while back in focus, but not so much interest specifically in target maturity funds, as Amitabh mentioned. With that, we'll take your leave on this edition of MF Corner, but stay tuned for Closing Bell to take you through the last hour of trade.